All right, guys. Good afternoon. Now, this is Khalid Nathan Aleem, the real estate board team lead of the B.O.S.S Network, and welcome to January's our first virtual lunch and learn. So, hope y'all got your lunch. Hope y'all ready to learn. Today, we got a special guest. I've had Jeff on a couple times here, uh, but wanted to bring him back on. He's somebody that's very astute in this lender game. He feels almost any questions on it. And I wanted him to come on and talk about 100% financing. I know a lot of people might throw this out there, but the execution of it is something totally different. So what we're going to do here, just so everybody knows, is we're going to break this meeting up into two parts. The first part is going to be Jeff talking about how to get your clients, your buyers, 100% financing. And the second part is I'm going to be talking about the 7 fastest ways to grow your business in 2025. So I'm going to put myself on mute. I'm going to let Jeff go. And just to introduce Jeff again, Jeff is a lender from Fulton Bank. So I'm going to have him come up, introduce himself again, let you guys know where to contact him in, and I'm going to give him the floor, man, to tell you about 100% financing.
Appreciate the introduction. Usually I'll have my Fulton, polo on or sweatshirt, but given the fact the Eagles are about to go to the Super Bowl, I'm only wearing Eagles until the Super Bowl is over. So I actually, I work for Fulton Bank. I specialize in first-time home buyers, and not just using the word first-time home buyers, but low to moderate income borrowers, and understanding the nuances, which is what I think Khalid was referring to be able to offer the product but actually deliver it effectively and get people to closing. Because I'm sure everybody's heard horror stories of trying to utilize low down payment options or grant options, but then the files falling apart halfway or at the finish line. So what I wanted to cover was how we offer our 100% product, but also how to stack certain grants that are available in our marketplace. And I like to keep it simple. So one, I wanted to make sure that we at least talk about Philadelphia's income limits. So when people talk about first-time home buyers, or when people talk about low to moderate income borrower, in Philadelphia, the 80% area median income limit is 91,760. In my opinion, I think that's substantial. I think that provides a borrower with a lot of buying power, and I think it alleviates the misconception a borrower has to make low income to qualify for any special affordable products, or in the lending world, they call it special purpose credit programs, such as our 100% product. So that's one of the things I was asked to speak about. Let me just explain to you how our Fulton Bank's combo program works. We do it as an 80-20, so 80% first, 20% second. Both loans are the exact same terms. So it's a 30-year fix on both. The interest rate is the same on both. The only reason we separate the two is for risk factors. 80% will get sold to Fannie or Freddie. It'll be serviced by us, and 20% we hold. The reason we do that is in case, and nobody likes to imagine the worst, but if the house were to be foreclosed on, we're only exposed by the 20% that we're holding, and Fannie and Freddie took responsibility for the other 80%. On the 80-20, one of the other benefits, aside from no down payment, there's no mortgage insurance. I think one of the things that causes affordability issues is mortgage insurance. One of the reasons that FHA, the Federal Housing Administration loan, is utilized as much as it is because if you happen to have a borrower that has less than perfect credit on a conventional loan that has mortgage insurance, it can become very expensive very quickly. With FHA, it's the same mortgage insurance whether you have a 580 score or an 800 score. The only other problem with FHA is it's mortgage insurance for life. So on the conventional loan, that's how we utilize the 80-20 program to do zero down payment. But in Philadelphia, if you're familiar, there are numerous grants that can help take your loan to value over the 100% mark. So I'll give you an example. If you have a $100,000, and I apologize, my math is not good. So on a $100,000 purchase, on a conventional loan, we do a 3% conventional loan with no mortgage insurance as well. So 3% is $3,000 a borrower to come up with. In Philly, you can do the Philly First Home Grant, for example. That's 6% of the sales price up to $10,000. So on a $100,000 purchase, that's $6,000. The reason that number is so important is because that 3% of the $6,000 can be used towards the remaining down payment for the 3% conventional loan. Plus, you have an additional $3,000 to utilize towards closing costs. So again, that's another way to get over 100%, again, of the down payment for the house. Obviously, as the house increases, we have to figure out a way to stack more grants. Soon, we're almost at the end of January. In about 2 months, First Front Door is going to open up. That's going to be a $15,000 grant, which again, not a CLTV. It's forgiven in 5 years. The $15,000 again increases your buying power. So if you have a conventional loan with 3% down, or it could work with our combo loan. So when that comes out, I think that's going to be a very aggressive product, because for our 80/20, it can stack with the Philly First home. I'm sorry, I apologize. First Front Door, even I'm getting confused. It can stack with the First Front Door. So that could be an additional $15,000 in closing costs. So if you have 100% financing from the bank, no down payment requirement, plus you have $15,000 that you can reserve in advance for your borrower, that could literally cover almost all closing costs. Now, First Front Door does require you have $1,500 of your own funds in the deal, but that's a very aggressive combination. That's one of the reasons that, for example, PHFA, if you use the K-Fit grant, that's one of the reasons that product was so sought after, because of the income limits. But again, I wanted to make sure that everybody knew the area median income limit is $91,000 in Philadelphia. It's pretty aggressive. The other benefit of the program for that 80%, it's only qualified income from the borrower. The reason that's important is because most other grants, Philly First Home included, First Front Door included, every one of them except there's a new grant that I'm going to talk about later, they pay attention to household income, all income in the property. But to give you an easy example, say a borrower has a primary job they've held forever, and they picked up a second job, or they have a spouse or somebody else living in the home that's also employed. When you're utilizing Philly First, when you're utilizing First Front Door, all these other grant opportunities, they're paying attention to the household income. That might disqualify numerous amounts of borrowers. So that's why our combo loan, I like to call it in case of emergency loan, allows a borrower that if their primary income is enough to purchase the property, 100% financing could get them to the finish line. But then we just have to figure out how to get the remaining funds. But that's something as a realtor, you want to make sure that whatever lender you're utilizing is looking at all options instead of just defaulting to FHA and hoping for a 6% seller's assist. One of the other benefits that is out there is Fannie and Freddie providing a $2,500 lender credit. That's, we call it the VLIP program. So if somebody has 50% of the area median income, meaning if they make less than $57,000 in qualified income, they can get $2,500 credit at closing. It's not a lien. It's just they get it at closing. It's a credit, and they're done. They don't have to pay it back. Nothing like that. We do have an in-house up to $5,000 grant. The only thing about that grant is it does have to get paid back at some point if the house ever gets sold or etc. But again, that $5,000 can help qualify somebody again to finish covering the down payment. So that money could be used for down payment or closing costs. So that's also important to remember. There's a new grant coming out. I was advertising it earlier. I think next month is the kickoff. But the original Wells Fargo City Lift for $15,000. We're one of the lenders. I think there's only like 2 or 3 other lenders aside from Fulton Bank that's eligible to offer it. So if your borrower gets housing counseling from affordable housing centers of PA and they qualify for the program, they can get up to $15,000 in down payment and closing cost assistance. I think it's an aggressive grant. They're very flexible. They did say that they were going by qualified income, not necessarily household. But one of the other benefits that they added on top, they don't care what lien position they're in, which is also important because Philly First, the $10,000 grant, 6% up to $10,000, has to be in second lien position. So if you've ever been a realtor that wanted to know how do you stack grants and how do people get in trouble by trying to do so, you have to know what position that grant needs to be and what requirements it has. Because like I said, if you have a grant that doesn't care, like for example, First Front Door doesn't have to be in a position. That's why First Front Door and Philly First go together. PHFA's K-Fit has to be in second position also. So K-Fit is a grant that's 5% of the sales price, no limit. But that has to be in second lien. That's why the PHFA's K-Fit and Philly First can go together because both of those grants have to be in second lien, and that's why you can never stack them together. So I think that the city lift grant that's going to be coming out is going to also help, I think, increase affordability. The other thing about it that I thought was interesting is they added that of the 15,000, you are able to utilize up to 5,000 of that money to pay off any kind of collections, installment loan, etc. It can't be used to pay down a debt, but it can be used to pay off a debt. So say you had a loan like $3,000 collection, or whatever, a car payment that has like $3,000 left, but not a lease, but like a car loan, you can use up to $5,000 to pay off that debt to qualify. I haven't seen anybody else offer that. I thought that was a very interesting feature that they were utilizing. Obviously, the important thing is to make sure that your borrower gets into housing counseling as soon as possible with affordable housing centers of PA. So I think that's an important one to keep in mind as well. The income part I do want to talk about. So we're mentioning all of these opportunities between low and no down payment, grants that also help with closing costs and down payment assistance. One of the things is talking about the income. So when qualifying a borrower, sometimes it could be as simple as a 1-minute application. Sometimes it might take a week or two just to get a person qualified. When you're looking at a borrower's affordability, we're looking at a history. And the problem is the average borrower that's purchasing, we'll just say like a low to moderate income borrower, is usually an hourly wage employee. It's not usually a salary. I would say at least a majority of my applications always come in. They are hourly employees with variable income. Variable meaning it's not a salary, meaning its hours vary from week to week, and the incentives vary from week to week. Prime example would be anybody that works in like a hospital. When you see the paycheck, you're going to see like 10 different lines of how that person is paid. As a lender, not just us, but all lenders. When you have a borrower that has that, you got to be careful when you get a pre-qualification, meaning the loan officer by themselves decided to evaluate income. You want to make sure that an underwriter reviews that income, and here's why. Some people will take the pay stub and give value to the income of whatever that pay stub was. Meaning, like if it was 40 hours that week at $30 an hour, that's the income. And the problem is when you look at the 2-year history, you have to figure out what was the average. And almost always there's a fluctuation. The key is what was the fluctuation, what was the cause? And I'll give you a live example that just happened this week. Borrower's been working at the same job since 2017, but there was a big increase last year versus the year before that. Logical explanation, the reason was she was hurt on the job and she was out for 6 months, then came back, then got like a $3 raise. So like there's a lot of variables that are coming into place. But the problem we have to identify is how many hours did she work? And then I happen to know as a loan officer that I can average it over today's pay rate, not necessarily averaging the income. Because what some people might do, and I know this is getting probably a little too deep, is they'll just average over time, meaning like you made X amount of money in 22, you made X amount of money in 23 or 24. But I know that if I need more income, I need this person to qualify for more, I'm going to get this person to go, or we're going to verify with the employer, how many hours did they work of qualified time at today's pay rate. Those are those nuances of why one lender can qualify a borrower better than another lender. Because unfortunately, it's up to the loan officer. There's human intelligence involved. So your loan officer has to know what do they have at their disposal to try to get the highest qualifying income from this borrower. For the same reason that if a borrower has enough base income to qualify, but they have overtime or bonus, I know that if I exclude it, that might take them under the limit, and then I can offer an affordable product as opposed to not. Prime example, if somebody made $90,000 in base pay and $10,000 in overtime, I know that if I use the overtime, I can't use my 80-20. They're not going to qualify for a 3% down with no MI. And by doing that, I'm disqualifying them from a more affordable product. But knowing that I can exclude that income, I can now qualify them for a better product with better financing. Those are some of the nuances when we do these lunch and learns to make sure that you see like there's a little bit more that goes on, and it's okay to ask the lender, how did you qualify them, as opposed to just looking at the paper saying, good, let's get out there, let's show houses. And I think one of the realtors made a comment, it's cold, you don't want to be out there, and you definitely don't want to be spinning wheels showing houses that the borrower might not be able to afford or finish the transaction on. So knowing what questions to ask that lender, like, hey, did you verify the income? Did an underwriter review the income? Has the person been at the job for enough time? Did they change jobs? A lot of these things cause hiccups. And if you ever hear those horror stories, it usually starts with they changed jobs, changed pay, they were out. So And then credit review, wanted to touch on that. Things to look out for on credit if you ever ask anybody if you get a pre-approval. Student loans is still something you want to ask or make sure that they're okay on. But I think we covered combo. How am I doing on time? 12:15. I wanted to see if anybody had any questions while we're on it. We have a small group, so I'll be happy to answer anything that maybe somebody came across or anything you wanted me to touch in on deeper.
Hi, Jeff. This is Darcel Grant. Thank you for this
Hey, that's
information.
all.
Hi, I
Mhm.
did have a question regarding student loans. You just brought it up, and then is that something that could deter? Because I know, like with renting, it might be a little different, right? A lot of landlords might bypass if the person has a lot of student loans, and it's okay if they might be late on payments. But in the case of a mortgage, you're saying the client should be very consistent with those payments?
Yeah, I apologize. I only stopped for a second because I covered a lot about the income, and that's why I was like, before I get into that part, I wanted to see if anybody had any questions before I went into credit, because that's a whole separate category. But let me just answer your question about student loans. The student loans has three ways that we can handle it, and the thing that causes trouble or frustration is if say somebody's in deferment for a student loan, whether you go conventional, whether you go FHA, we'll require, and VA as well, but let's just talk about conventional and FHA. We are required to add a payment. So depending on if it's a conventional Fannie Mae loan and it's in deferment or forbearance, we have to use 1%. If they're on an income-based repayment and it's zero, Fannie Mae lets you use zero. Now here's where the problem comes in. If it's a Freddie Mac loan, so there's two big conventional loan servicers, there's Fannie and there's Freddie. They're the ones that give us the rules. Freddie says if you have a $0 income-based repayment, meaning like you apply for an income-based repayment, you provided your income documentation, and they said based on your income, your payment is zero, Freddie Mac and FHA will require us to use 0.5%. So on $100,000 in student loans, that's $500 that the borrower is not currently physically paying that will now count against their monthly debt obligation. And that's why when that number comes in lower of what they think they can afford versus what the bank says you can afford, that's usually where the disconnect comes in. Now, most after the CARES Act, when COVID was over and the CARES Act expired, everybody, for the most part, went back to a monthly payment. So usually when we pull credit, it shows now. Some still are in deferment. Somebody's going back and taking classes. But if it does show a deferment or forbearance, that's where I say, like, if somebody did, I don't want to say did it for no reason, but if they could have applied for an income base and they know they're going for a mortgage, I would take care of that sooner than later so that you can provide your lender with that paperwork. But again, let me just tell you about why you will go one program over another. Being able to offer a Fannie Mae loan and a Freddie Mac loan, 0.5% and 1%. So to give you an example, on say $100,000, you go one way, it's $500 as a monthly obligation. The other way is $250. That's almost like a car. So it's like knowing that you have options to go one way or the other to, again, create more affordability. It's a good resource. So, and then that's why sometimes like I don't default to FHAs because FHA doesn't care about the income-based repayment. If it's as long as it says $1, you can use it. If it's a zero, you're using 0.5%, which is insanity to me. Because like I said, if it was $1, it's fine. If it's zero, it's 0.5% of the balance. So I hope that helps.
Thank you. That helps.
Yeah, no problem. And then in that regard, some of the other stuff, and again, this is just more for awareness, is like if anybody that's co-signed for something, especially student loans, if you co-sign for a child or vice versa, that you co-sign for student loans, if that person, and this usually goes with all debt, if the person that you co-signed for has made at least 12 payments on their own with their own money out of their own account, we can exclude that debt. That goes for a car, credit cards, house. If you co-sign, but the rule requires 12 months, the other person has to have made the payment themselves, meaning they did not give the borrower the money and the borrower made the payment. You have to document 12 months out of their own account with their own money, and then you can exclude it. You'd be surprised how often that comes up. And that's also sometimes why a borrower might be not properly qualified, and tell them that, here's your qualified amount, not asking the additional question like, hey, is any of this debt somebody else is paying for? Because on the credit report as a loan officer, you can see if it says joint. So if you have a single borrower applying for credit and then you see a J on the account, you should be asking whose account is this, what's going on with the account, who's paying the account, can you document it? So something to keep in mind as well. I don't know how a landlord does it. I don't think they get that deep into it, but I mean, it's something, that's how all lenders, not just Fulton Bank, that's how all lenders handle student loans.
A
Student loans is
question.
the bane of my existence.
This is AC. Just a quick question.
Okay.
Outside of the first-time
Mhm.
home buyer grants, Philly First and Fannie Mae, and all of that, what programs does Fulton have to support buyers who are not first-timers?
So all of the programs that I mentioned are 80/20. You don't have to be a first-time home buyer. So none
Okay.
of our products require you to be a first-time home buyer. I feel like because of Philly First and First From Door and stuff like that, like you like to say it together so everybody understands like that's what they're for. But technically speaking, I have a bar now that's downgrading. They need a rancher. They're getting of age and they don't want to have a two-story house anymore. They're using the 80/20 combo just to buy it. So all of the programs we offer, including our up to $5,000 grant, you do not have to be a first-time home buyer for. I will say that Fannie and Freddie changed that $2,500 DLIP grant, that credit. Before it was anybody that's 50% of the area median income. Now it's going to be at least one bar has to be a first-time home buyer to get that credit.
Okay.
So most external grants and county grants, they're going to require you to be a first-time home buyer.
Really quick question,
Good
man.
question.
I know the answer, but there's some agents that are new to the business in here. So I want to ask for them, if I have somebody who wants to buy a home, but their credit score is in the toilet, should I tell them to wait to get their credit fixed and then come to you? Or Lottie Dottie and everybody, if they want to buy a home, I should have them come to you or come to a lender to get right?
I recommend in that scenario, I'd go to the housing counselor first. So just to talk about what happens at housing counseling, like what happens behind the scenes. Aside from the fact that they're going to get one-on-one counseling, aside from the fact they're going to review what actually is going on with the credit and see what, like if it's going to be a long journey or a short journey to get them on track to be purchase ready. But they also have, and I don't want to do everybody's loan, but they also have access to all the programs that are available in the area and what lenders do what. So that, I like to think I'm one of the best, but I mean, I'm not the only game in town that can do certain loans. So they'll know when a person has a certain profile, if there might be a better fit for them to get qualified. So I would do the housing counseling. I also say, like, because of the getting an additional inquiry when not needed, I actually added on my my mobile app a free link to Experience. So if somebody says they don't know what's on their credit, I even have the link on my mobile app. Like they can just quickly do it. I think it takes 2 minutes. You can pull up your Experian credit score to see if it's over 620 or not. Then anytime somebody can avoid getting a hard inquiry when they don't need it, because if they go to a housing counselor, it's not an inquiry. Soft pull, I mean, that also helps. Because otherwise you're taking them another step back. And when you use the word like in the toilet, that's what I meant about like there's a ride. So say somebody's like in the low fives or fours, it depends on what's on them. Because and just to let you know, like credit report, it's a story that everybody's going to need for life. So if you ever talk to somebody, I know realtors don't necessarily want to get into the that conversation of what's on your credit. I always just ask as a general, you don't have to say the answer, but it kind of like you see where they're at. Like, do you follow your credit on anything? In this day and age, you have access to follow your credit on literally almost any platform. Every credit card company offers it. I mean, every bank offers it. Like everybody offers you a way to follow it. Anything to get away from Credit Karma. Just make sure that nobody says Credit Karma anymore. But if they say like CreditWise or any of the banks that offer it, you can just say, do you follow it? Is it good? Because then you can better advise, Because it's the same as saying, like, if somebody's trying to buy a house and they're like, listen, I have, $100 saved. Where do you take that conversation? It's going to be a little bit of a ride. Like, where are you going to come up with the funds? How do we get you on track to show that you have the funds to, purchase a home? Because even most of the stuff, and I do want to say this with a huge asterisk, sometimes the stars align, the bar does everything right, and you stack so much grant, and Khalid, you and I have done it. I remember the borrowers, where they literally came out of pocket virtually almost nothing. I think they were getting money back from their earnest money deposit at closing. They were getting some of the money back. But that's when everything falls in line. That's not everybody's scenario. So if somebody doesn't have any savings, it's two things are going to happen. One, even if as a lender, when I run it through the system is going to evaluate your credit, your income, and your assets. All of it's looking for how high risk is this borrower. If a borrower is borrowing, say, on my 80/20, 100% financing, average credit and no money, that's going to be high risk. It's going to be difficult for the system to approve because it's going to factor in all of those risk layers. No equity in the project, no marginal credit score, there's no mortgage insurance on the loan, and none of the borrower's own funds. That's going to be difficult. So like, the credit score, like if it's, like I said, to lean back to your question, I would always have a good housing counselor on standby that can just be ready to help. I have a couple good ones that I always just default to. If somebody tells me the same thing you said, if they say like this, I don't think it's where it needs to be, then have that conversation first. Get the housing counseling completed. Also keep in mind the housing counseling certificate, so everybody knows, is good for 12 months. So even if the person goes, by the time they get into counseling, by the time they do everything, when they get their certificate, while they're getting back on track, that certificate is good for 12 months. And those that might not know, the Philly First Home, you are required to have the housing counseling completed before you sign an agreement of sale. The new City Lift program, again, required housing counseling is completed before you sign an agreement of sale. So those are also important parts, because if you skip that step and you're counting on that money and your loan officer might not be well versed in it and they proceed as if, and then you find out that they're not going to get that money, that's usually where I come in with the emergency loan. So just so you know, that's actually happened, where people proceeded thinking that they're getting the Philly First. Nobody communicated with each other that the counseling wasn't completed, but the loan officer, since we don't control the Philly First, if the borrower said it, the loan officer didn't know any better. I mean, that's how you get deep into the product, deep into the transaction before you find out you have a problem. But yeah, good stuff. This is a great call.
All right, cool, man. Cool. Well, thanks for the time. If anybody wants to reach out to Jeff, man, well, why don't you give them your phone number or tell them your website as far as where they can reach you at?
So my phone number is 267-736-7962. I'll also put it in the chat. That's the best number to reach me, and then I'll put the link to the mobile app that I was telling you about so that you can check it out. Let me know your thoughts.
Awesome. And the thing for real estate agents is, I know lending is kind of the other side of the fence, but the more you know about it, the more you become more valuable to your clients, because then you can protect them from some people who may know less than Jeff. Okay. Because with this transaction, man, there's a lot of moving parts. And you really want to be knowledgeable about all those parts so you can protect your clients, because at the end of the day, for the most part, you're bringing a buyer. Okay. And you want to protect those buyers. And the more that you know about other facets of the industry, the better you'll be. So want to thank Jeff for his time. Now we're going to get into the second part of this presentation. And it's going to be the 7 fastest ways to grow your real estate business in 2025. So give me 1 second here while I get my presentation up here, and then I will share my screen. Let's see, participate. Okay, let me share my screen here. Okay, can you guys see my screen?
I see a black screen, but it has your name. Oh yeah, I see it now.
Okay, it's up now. You can see the building and everything.
Yes.
All right, cool. All right, guys. Well, again, this is the 7 fastest ways to grow your real estate business in 2025. We are at the end of the first month. And in a minute here, we're going to be at the end of the first quarter. Okay. So if it hasn't picked up for you, it should pick up for you after you implement these 7 ideas. Okay. Again, my name is Khalid Nathan Aleem, top producing real estate agent in Philadelphia metro area and team leader of the B.O.S.S network, brokered by Real. All right. So let me just get to the first one. Okay. All right. So the first thing you need to do, be seen. Be seen. You got to be seen. Here's the equation. The more you're seen, the more you're going to make. Okay. I know everybody has heard the adage, you can't be a secret agent. So you can't be, oh, well, I'm an agent and I have my license, but I'm not talking to anybody. No, you have to be seen. The more you are seen, the more money you'll make. There are billions and billions of people out there. Okay. Your cold market is like this. Okay. Your warm market is like this. So, yes, the warm market, that's the low hanging fruit. You definitely want to take advantage of them. But the cold market is like this. And the more of those folks that see you, the more money you're going to make. Okay. Now, what are some things that you can do? And again, this list can go on and on and on, but I'm just going to throw these things out there. Okay. Number one is hosting open houses. Now, a lot of times when people think about open houses, they just think about that particular house. Here's the thing, it's not about the house. It's not about the house. It's about the marketing around the house and reaching those people. That open house is really just a lead magnet. That's all that house itself is just a lead magnet. That's it. Okay. But what you can do is you can use open houses to propel your business into the next stratosphere. You just need to have a game plan around it. Okay. And we can definitely, if you want to reach out to me, we can talk about that game plan. But some of the things is through social media, through circle dialing, meeting the people or contacting the people around the open house. Okay. There's a billion and one things you can do with an open house. All right. So that's the first thing. Also, direct mail campaigns. Direct mail campaigns, you're really farming an area. So you're looking for one area, let's just say University City. You're looking at University City and you're sending mailers. Now, this can get a little expensive. Okay. It can get a little expensive, but it's something that's systematic and it's something that can be constant. That's the key thing. A lot of people do lead generations, but what they do is not constant. Mail is something that's constant. And now it's come to the point where people are looking for mail. Even me, we don't get a whole lot of mail, do we? Everything is email, everything is electronic. Okay. So when we get mail, I think we value it a little bit more than we did in the past. So this is something that's old but true. Okay. Old, tried, and true. That's the word I wanted to use. Direct mail campaign. So you can reach out to local homeowners, you can personalize it, and you can have some value driven message to those individuals. Also, leverage social media. Everybody has what in their hands? Their phone. They have their phones in their hands. So if the key is attention, because that's the key today. The key today is what? Attention, not dollars, but attention. If you have the attention, the dollars will come. Okay. So if you leverage social media, you're ahead of the game. And it doesn't just have to be videos. Videos are good. And I implore every real estate agent to do videos, but it doesn't just have to be videos. You got people who are killing it blogging. You got people who have faceless videos. There are so many avenues to do with leveraging social media, but you gotta be consistent. You gotta consistently do it, and you have to find some way to engage. You have to find some way to engage people because people are used to doing what they're used to just looking at their phone, and that's it. But there's a skill to engaging people because the transaction starts in your conversation. Everything starts with what? A conversation. So you want to keep that top of mind when you're dealing with social media is you want to get people into a conversation. If you're just posting and people are just looking at you, there's really nothing you can do with that. But look at it and get some type of dopamine because you see, okay, I have 100 likes on there, or I have 1,000 people looking at that video. It won't get you anywhere. You need engagement. You need conversation. You need to get in conversation with the individuals that are liking your posts. And I don't want to turn this into a social media class, but for example, polls. Polls are a way to get people to engage. Asking questions are ways to get people engaged. So on social media, you have to get people engaged in order for you to get into a conversation. Once you get into a conversation, then that's when the conversion takes place from turning people from customers or just people that are looking to clients. And this is what you really want to do. Okay. So number one is to be seen. The more you're seen, the more money you'll make. All right. Let's go to number two. If I can get this up here. All right. I'm not sure why it's not going. Come on. Don't have a technical difficulty on me now. See if I can just. There we go. Okay. Tell relatable stories. This is something that's a lost art for a lot of people. Why? Because the industry, not just you, but the industry, what do? We sell a home, we put a sold post on our Facebook post. If we just listed a property, we'll put a just listed post on there. Okay. We're posting people to death. And what happens is that people just kind of look past what we're doing. I'm not saying don't do it, because you want to know people, you want to let people know that you're busy. Okay. But again, what did I say was the key factor with social media posting? Is engagement. Okay. It's conversation. People want to relate. This is what they want to do. So instead of just putting the just listed, write a story on how you got that listing. Or if you sold the property, then write a story about how you sold the property. If you had a buyer that just purchased the property, write a story, a relatable story. People are engaged in the stories. Even when I post, when I post business information, it gets one set of engagement. But when I post personal things, it gets a whole other set of engagement. And when I post a story, it just skyrockets the engagement. And that's what you're really looking for. You're looking for the engagement, because in the engagement comes the conversion. All right. So you want to make personalized posts. Okay. Share stories about helping your clients achieve their goals, because you want to start what? You want to start a conversation. Okay. Don't lose that. And you also want to connect emotionally. Sometimes texts, emails, posting, sometimes it can be cold. It can be cold. But you want to show people that you understand your audience needs. How do you do that? By telling stories. By telling stories. Make your stories relatable to the people you're trying to capture. And the thing about it is, people say, "Oh, well, I want to get everybody." Well, as they say, if you're talking to everybody, you're talking to nobody. Find out who your avatar is. Find out who your avatar is, and you can use Chat GPT. You can go to GPT and say, "Who's my avatar? This is who I am. This is where I'm at. I serve the Philadelphia metro area. Who's my avatar?" And they're going to come back to you with a detailed list of what your avatar is. Now, when you're writing posts, you're speaking to that avatar. Some people get their avatar so dialed in that they give it a name, that they give that avatar a name. So every time they make a post, they gear it towards that person. Okay. And it will reach that person. All right. So when you're telling stories, make them relatable. Personalize your posts versus just sold, just listed, just bought, something like that. Okay. Let's move on here, guys. All right. The next one is steal ideas and make them your own. You do not have to discover the wheel. Okay. You don't. There are so many real estate agents out there. And guess what? The good thing is that they're not all in your market. They're not all in the Philadelphia market. Okay. But the marketing is the same. It's just changing what? The location is changing. So steal other people's ideas and make them your own. Okay. How do you do that? Look outside of your market. Go on social media. For example, let's just take YouTube. If you want to make YouTube videos, then check out people who are killing it in Texas. Check out people that are killing it in California. Check out people that are killing it in Florida. And all you have to do is just customize it. Okay. Find fresh ideas and inspiration from successful agents elsewhere. You can go on social media. You can go on YouTube. You can go on Instagram. and find out, okay, who's killing it in Charlotte? Okay, let me do the same thing they're doing and let me just put my spin on it. Okay. Customize their existing strategies and align the strategies and campaigns with your brand and your local market. Okay. And click through their funnels. Okay. Um, one of my guys, Dave, I just clicked through his funnel. Dave Foster. I clicked through his funnel maybe like a week ago. I was scrolling, and I seen his ad. I said, "Oh, that's a decent ad." And I went in. It was a Facebook ad, and I went in and followed his funnel, and I took some tips from that. It's not that you want to rip everything off verbatim, but take the idea and put your spin on it. Okay. So you're not always like, it's not so hard on you. It's not so hard on you where you have to, oh, well, how do I do Facebook ads? Well, how am I going to advertise on Instagram? Or how am I going to do YouTube videos? What type of, no, you don't have to do all that, especially when it comes to social media, because there are already people that are doing it. That also, if you want to do billboards, or if you want to do di- direct mailing campaigns, or anything that you want to do in real estate, somebody else is already doing it in other markets. Find out who they are. One way to find out is from podcasts. If you're in this business of being a real estate agent, you should be listening to real estate agent podcasts, because these are people from all over the world and are giving up their secrets on these podcasts. Why? Because they know most people are not going to do them. They know most people are not going to do them. Okay. So that's one thing that you should have in your repertoire. One really good podcast is Rockstar Agents. It's either Rockstar Agents or Rockstar Real Estate Agents. Okay. But that's a really good podcast. But there's a plethora of them out there. So just go to Apple or wherever you get your podcast and make sure regularly you're listening to real estate agent podcasts. Okay. Let's move on. Okay. Next is focus on growing your database. This is a good one. Okay. Your database will coincide with how much money you make. Your database will coincide with how much money you make. If your database is like this, your paycheck is probably going to be like this. Okay. If your database is like this, then your paycheck will probably be like this. You want to be in the business of adding people to your database. How do you do that? You can do that from, I mean, there's a billion and one different ways to add people to your database. Even if you go out to the grocery store, there's one guy, I didn't do this, but I seen this one guy on one of these podcasts where his first year or two, he just went to the grocery store with business cards, and he just acted like he was uh picking fruit or getting some type of groceries. Hey, how you doing? You looking for cereal? Hey, my name's Khalid Nathan Aleem. I'm a real estate agent. If you're ever looking to buy or sell or invest in real estate, I got you. And gave him the business card. And I mean, he sold like over 100 homes that one year. So you want to grow your database. Why? Because I'm talking about social media, and I'm really heavy on social media. But here's the thing, is they can kick you off at any time. Social media can kick you off at any time. What does that mean? That means YouTube can shut down your account. And they have shut down people's accounts who have millions of followers. Instagram can kick you off like that. Facebook can take you off like that. So you got all of these followers and you left them on social media, and then something happens and they take them away like that. No, what you want to do is take those people off of social media and put them into your database. Okay. Because your email list, that's your social media platform. They can't take that away from you. So you want to constantly be growing your email list. That's your database. And when you get that database, you want to nurture that database, not just keep them there. You have to nurture them. How? By sending them newsletters with value. That's the key point, is you got to be sending them value. There has to be a reason for them to tune in. You got to give them a reason to tune in. So, like I said, some things you can do is send out newsletters. Some things that you can send out is, or some things that you can do is send out property lists, property tours, private property tours. Give them a reason to be in your database. Give them a reason to be in your database. And if some of this stuff you don't know, it's like, oh, well, I don't really know how to do that. Go to ChatGPT. I promise you, ChatGPT will figure it out for you. I promise you. Okay. And you want to be consistent in your communication. That's key. So whether you're calling your database, whether you're texting your database, whether you're emailing your database, okay? And not that I'm trying to give a plug to Lofty, but Lofty is something at Real that they give us for only $40 a month, and it's something, it's a CRM where it emails your database for you. It texts your database for you. It also has an AI component where the AI assistant texts your database. Okay. So it almost does everything but actually call the clients for you. Okay. You got to do something. All right. So that's number four. Number four is growing your database. All right. Let me see number five. Number five is this is a contact sport. Yes, this is a contact sport. You can't just sit in your cubicle. You can't just sit behind a desk. You have to get out there and you have to communicate with your database regularly. Okay. Reach out through personal messages, calls, also, again, newsletters. You have to water because we're really like farmers because people don't really buy or sell homes, but what, two, three, four times in their lifetime. In their lifetime. So our job is to be there when they're ready. So, which farmer reaps the most crops? The one who plants the most. The one who plants the most. So, how many seeds are you planting? This is the key. This is the key to success. How many seeds are you planting? Because if you're only planting a little, you only gonna get a little. That's it. But in any case, um, it's a contact sport. It's a contact sport. All right. And you got to provide real value. But in order for you to provide real value, you got to know something. You got to know something. That's why education is key here. Yes, this is a contact sport, but you got to be hitting with something. You got to be hitting with value. If you hitting with fluff, you wasting people's time. You wasting people's time. So that's why training is super important. Training and ongoing training is super important. So that's why you got to continuously training, put yourself out there so you can learn more, so you can earn more. Okay. And you want to convert your database. You just don't want to have this big database just for nothing. You actually want to aim to convert them because it's said that you convert 8% of your database into clients each year. So how big is your database? Because that 8% gets larger based on how many people you actually have in your database. So that's one of the important thing about lead generation. Lead generation is really what? Growing your database, growing people that when it's time to buy a home or to sell a home, they're thinking about Khalid Nathan Aleem. Okay. Let's continue. Got 10 more minutes here, not to keep you guys. Number six is identify and reward your MVPs. You know, we like appreciation. We all like a good pat on the back. Good job. You doing a good job. Thanks. Look at your business and identify the MVPs. It might just be one person. It might just be one person, okay? But recognize your clients or your contacts who have helped your business. Maybe it's somebody that bought a home and sold a home with you, or sold a home with you and bought a home with you that year. Or maybe you have an investor and they did two or three purchases. You want to make sure you celebrate them somehow. Let them know, let them know that they're special to you because they're helping your business. They're helping you put food on your table. So you definitely want to specify them out. You can either go so far is to inviting them to exclusive events, dinners, non-alcoholic happy hours, and personal thank you outings, even sporting events. You can get maybe season tickets to the Phillies and invite special clients. So there's a million and one things that you can do. But what you want to do, the point of it is that you want to recognize them, even if it's a thank you letter, a personalized thank you letter. And again, if you run out of ideas, you can go to ChatGPT and you can say, hey, how do I recognize the people who have given me the most referrals? And it's going to give you a laundry list of ideas of things that you can do. Okay. But this is something that's not going to pay you right now, but it's going to pay off in the future. So it's something that you want to think about and put into your calendar. Make sure you put into your calendar. And last but not least, is be the best version of yourself. Be the best version of yourself. Because we talk about now giving off vibes. Okay. What type of vibes are you giving off? What type of vibes are you giving to other people? What's your disposition? Because as a real estate agent, you're always on. You're never working and always working. You're never working and always working. Because even if you go into the store and you're just buying groceries, even though you're not in the office, you're not calling somebody, you're still working. Are you advertising without advertising? Meaning maybe you have a shirt on that says, ask me about buying a home. Or you may have a hat on that says, I love real estate. But just understand that people are always looking at you and people are always judging you. So if you go out to the store and you want to market yourself, you may not be able to put that bonnet on, okay? Or you may not be able just to go out in those sweatpants and a house coat, okay? You're going to have to get dressed a little bit so that you can be referable. So you can be referable. So if you do talk to somebody about real estate, they look at you and they like, okay, this is somebody that I can do business with, because they're going to judge you first on what? On your appearance. Okay. Prioritize your health. Prioritize your health. Because in this business, you may do a lot of, like I do a lot of sitting behind this desk. No, I got to get out. I got to get up. I got to work out every day. Or you may just be in the car driving around, driving from here to here to here to here, just eating crap. Okay. No, I'm not going to eat that. Maybe I'll take an energy bar or maybe I'll take a smoothie. Okay. So you want to make sure you prioritize your health, because if you don't have your health, what do you have? Okay. There's a saying, there's an Arabic saying that means that the healthy wear a crown only the sick can see. So you want to make sure that you're taking advantage of your health, and you want to make sure that you're healthy so you can keep what? So you can keep working, okay? So you can keep showing those homes. So anyway, make sure that you prioritize your health, okay? Also, you want to show up confidently. You want to show up confidently. And that comes from you. Okay. So you can't be having this argument. You can't be crashing out over here or crashing out over here. And then you go into an appointment and think that you're going to show up confidently. You're probably not. And also, confidence comes from what? From knowing what you're talking about. From knowing what you're talking about. And that happens when nobody's looking. That happens when nobody's looking. That's happening when you're studying in the background or you're listening to podcasts. Okay. That's where that comes into play. And people know about what you know by what? By how you're talking. But are you talking confidently? Or is it like, well, what type of words are you using? Okay. And also stay disciplined. Stay disciplined. This is a self-employment business, meaning what? You're the boss. And most people are easy on themselves. Most people are super easy on themselves. And this is a transition. This is a transition from being employed, because when you're employed, somebody else is telling you what to do. So it's easy. It's easy. Okay, do this, do this, do this. So you know exactly, you don't have to think about what to do. In this business, you have to think about what to do. You have to plan it. Then you have to execute, and you have to be disciplined, because there's not going to be anybody that tells you Oh, you don't have to make calls today. It's not going, and there's not going to be somebody that tells you, hey, you got to make calls today. Okay. This is probably one of the biggest downfalls of people when they get into this business is that they're not disciplined. And a lot of people aren't disciplined because they don't have a game plan. Because they don't have a game plan. Now you might say, okay, well, where do I get a game plan from? Go to Chat GBT. I mean, if you want to, we can sit down and come up with a game plan. Okay. But if you don't want to do that, then you can always go to Chat GBT, tell them about your business, and tell them to give you a game plan to sell 2 homes a month. And Chat GBT will lay that thing right on out for you. Okay. All right. So closing thought. The strategies above are proven ways to grow your business in 2025, but execution is the key. Execution is the key. Okay. Be visible. The more people that know you, the more money you will make. Be consistent. Be consistent because people want to see you show up over and over and over so they can why? So they can depend on you. Okay. Invest in your relationships. You got to spend some money, even though there are free ways to do things. Okay. And some of this, you're going to have to spend a little bit of money. Okay. And the results will follow. All right. So I want to thank everybody for coming to this January Lunch and Learn. Every Friday, I have a virtual book club. Right now, we're going over the Millionaire Real Estate Agent. It's at 9 o'clock. So if you're not on that list, DM me, text me, or email me. I'll get you on that list so you can make it because we're going over this powerful book, y'all. So I hope to see you guys in February. I will let you know what the date is and what the activity is going to be and the subject. This is Khalid Nathan Aleem, the real estate boy. Man, enjoy the rest of y'all day. Take care.
Thanks, Khalid. That was good.
Thank you.
No problem.